Welcome to the Deep Dive, powered by Talk Tickers. We're here to cut through the noise of earnings calls and get you straight to the real insights.
That's the goal.
Today, we are diving into the latest from J.Jill. We're looking at their second quarter fiscal year 2025.
Right.
And this wasn't just, another earnings report. Felt pretty pivotal. New CEO, some big strategic shifts.
And some interesting market reactions, too. A bit of gymnastics, like you said.
Exactly.
So yeah, we'll unpack J.Jill's performance, look at that new strategy under the new CEO, and definitely talk about the headwinds they're facing.
Headwinds is putting it mildly, maybe?
Maybe. But you'll get a clear picture of what drove Q2 and what to keep an eye on going forward.
Okay, let's do it. Headline numbers first. J.Jill's Q2 FY25.
Let's get into it.
They announced GAAP EPS of 69 cents. Adjusted EPS came in at 0.81 cents.
And that adjusted number, 0.81 cents, that actually beat the street. Consensus was what, 76 cents?
Yeah, 76 cents. So a solid beat there. Revenue also surprised a bit to the upside, $154.0 million.
Right, against expectations of about $149.5 million.
Although it was down just a tiny bit, 0.8% year over year.
A very slight dip. So yeah, on the surface, looks like strong beats, top and bottom line.
Definitely caught my eye.
But, it's never quite that simple, is it? There are nuances.
Always, like the gross margin.
Exactly. That saw a 210 basis point decline year over year. So 2.1 percentage points down, landed at 68.4%.
Okay, that's notable. And comps.
Comparable sales were also down 1.0%. On the plus side, though, free cash flow looked pretty healthy, $16.6 million.
Okay, and cash position. Inventory.
The end of the quarter, solid. $45.5 million in cash and about $55.3 million in inventory.
And the market reaction you mentioned. It was a bit of a ride.
It really was. An initial dip, pretty sharp actually, then it recovered through the day, showed investors were processing the good with the bad.
Digesting it all.
Yeah.
Okay, so let's get into the why behind those numbers. That gross margin compression, first 210 basis points, is quite a bit. What was driving that?
Well, the main thing was a higher mix of markdown sales and increased promotional rates.
So selling stuff cheaper, basically.
Pretty much. But here's the interesting part. Management says this was deliberate, a strategic choice.
Oh, to do what?
To clear out excess inventory, stuff that had built up because of a slowdown near the end of Q1.
Ah, okay. So taking a hit now to clean things up for later.
Exactly. It signals they want a leaner inventory model going forward, shows the new leadership is tackling old issues quickly, might mean more agility down the road.
Interesting. But it does make you wonder about the inventory management before, right?
It does raise that question, yeah. How much excess was there? Also, about 50 basis points of that margin pressure came directly from tariffs.
Right, the tariffs. We'll definitely need to talk more about those.
We will. And don't forget, SG&A expenses were up too.
Why was that?
Higher store expenses because of net new stores, higher rents on lease renewals, plus more spending on shipping and marketing. Kind of the usual suspects.
Okay, so they took a deliberate margin hit to fix inventory. That feels proactive, maybe aggressive. How does that fit with their capital management? Growth versus giving back to shareholders.
They're trying to walk that line, keep it disciplined. They did buy back some shares in Q2.
How much?
68,000 shares for about $1.0 million. And they still have $20 million left on that buyback authorization.
So signaling commitment there. And dividends.
But the quarterly dividend, 0.08 cents per share, was approved, payable October 1st.
Okay. And growth. Store plans.
Still pushing selective growth. They actually closed 2 stores in Q2, but they plan to open 2 new ones in Q3.
Net zero for now, but long term.
Long term, they're aiming for 50 new stores by the end of 2029, and they're spending $25 million on CapEx this year, mostly on stores and, tech, omni-channel stuff.
Investing carefully, it sounds like.
Seems that way.
Okay, let's shift to leadership. This was Mary Ellen Coyne's first full quarter as CEO. She started back in May. What's her plan? What are the big strategic priorities?
Right. This is where you really see the new direction taking shape. She's focused on 3 main areas.
Okay, number 1.
First, evolving the product assortment. This is key. They want to widen the appeal, bring in new customers, add more versatile styles.
How are they doing that?
They've brought in new people. A new chief merchandising officer, Courtney O'Connor, started in June, and a creative director, Elliot Staples.
So fresh eyes on the product.
Exactly. They're already working on spring 2026, plus tweaking fall and winter. They're also looking at expanding accessories, small area now, but potential to scale. and cutting out redundant styles.
Streamlining.
Makes sense. It's not just about new stuff. It's about making the whole offering stronger, getting more of that share of closet. And apparently customers are noticing already.
Oh, yeah. How so?
Responding well to cleaner color palettes, better window displays in the stores. Little things, but they add up.
Interesting. Cleaner color stories.
Thanks.
It suggests their core customer still values that curated look, maybe not just chasing fast fashion.
Could be an edge for them.
But the challenge is expanding appeal without losing that loyal base, right?
Always the balancing act in retail.
Okay, so product is priority one. What's number two?
Number two is enhancing the customer journey. Basically improving how they connect with and serve the customer.
So marketing, experience, that kind of thing.
Exactly. They're looking hard at their whole marketing mix, top to bottom of the funnel. They even did a small local TV ad test.
TV, really?
Yeah. And apparently it had tremendous impact. Shows there might be life in older channels yet.
Huh. Interesting.
So they're tweaking the marketing strategy for the second half, reshooting images for digital, catalogs, stores, making it all feel more cohesive.
And loyalty.
Big move there. They're planning a new loyalty rewards program, one that's not tied to their credit card.
Oh, that's smart. Broaden the reach beyond just card holders.
Precisely. It's a way to engage more customers, attract new ones, re-engage lapsed ones. Plus, they see their physical stores as key marketing tools too, not just places to sell.
Right. The store is brand experience. Okay, so product, customer journey. What's the third pillar?
Third is improving the way they work. This is more internal operational efficiency.
Technology.
Culture. Both. Developing a tech roadmap, looking at AI to boost growth and efficiency, making the customer experience better through back-end improvements.
AI for things like inventory, maybe.
Personalization. Exactly, those kinds of things. And fostering a more agile corporate culture, faster decisions, quicker adaptation, less siloed thinking.
Any concrete examples of that agility?
Yeah, actually, they rolled out ship from store across all their stores in July, and they did it ahead of schedule.
Oh, wow. That's a big omni-channel win.
Huge. Turns every store into a mini warehouse, should help drive sales, fill orders they couldn't before, and maybe even help margins by using store inventory better.
Okay, that sounds like a really comprehensive plan.
Yeah.
Product, customer, operations, hitting all the key areas.
It is very proactive.
But looming over all of this, the tariffs. You mentioned them impacting Q2 margin. How big of a problem is this going forward? And what are they doing?
It's a very big problem. The elephant in the room, like you said earlier. For Q3, they're bracing for about a $5 million incremental impact.
$5 million just in Q3.
Wow. And that's net of any offsets they get from vendors. And they expect similar hits each quarter if policies don't change.
Where are the tariffs hitting hardest?
Their biggest sourcing countries. India is now facing a just staggering 50% tariff rate. Average rates for their main sources are around 20% now, much higher than they planned for.
Yikes. So what's the counter strategy?
They're fighting it on multiple fronts, negotiating hard with vendors for savings, adjusting how much they order, and critically, strategically reviewing their pricing and promotions.
Meaning price increases.
Potentially, yes, or fewer promotions. Their goal is to offset the dollar amount of the tariffs, not necessarily maintain the exact margin rate.
Subtle but important distinction.
Very. It means they might eat some cost, or they might pass it on, which could squeeze margins initially if customers push back on higher prices.
Right, that whole price elasticity question. How much will customers tolerate?
That's the multi-million-dollar question they're watching very closely. It really shows how global trade policy hits home right down to the price tag in the store.
No kidding. Okay, so with all that, the internal plans, the external tariff pressure, what's the official outlook for Q3? What are they guiding?
It's cautious. For Q3, they expect net sales to be flat to down low single digits.
Okay.
Comparable sales down low to mid-single digits. Adjusted EBITDA between $18 million and $22 million.
And margins, given the tariffs.
Expected to be down even more than they were in Q2, primarily because of that tariff pressure hitting full force. They've also cut back on unit orders for the back half, being careful with inventory.
Understandable. That caution definitely frames the challenge. Let's swing back to the investors. You mentioned that stock roller coaster on earnings day. Pre-market drop, then a rebound.
Right. Dropped over 8% pre-market, down to $15.51. Clearly, that Q3 guide and the tariff numbers spooked people initially.
Front-running the bad news.
Pretty much. But then it climbed back, closed the day actually up 1.9% at $17.19, and on much higher volume, like 2.1 times the average.
So what does that tell you?
It suggests investors looked past the immediate Q3 pain. They saw the Q2 beats, heard management's detailed plan, acknowledged the disciplined operations, and maybe thought the initial sell-off was overdone.
A more nuanced view won out.
Seems like it. Analyst sentiment is still kind of cautious, though. Mostly hold ratings, price targets creeping up slightly to around $17. It's not wild enthusiasm, but maybe cautious optimism, belief that management can navigate.
A show-me period then. They laid out the plan, now they have to execute under pressure.
That sums it up well.
So if you're watching J.Jill, what are the key things to track, short-term and medium-term?
Okay, near term. Holiday season performance is crucial. How well does the merchandising land? How effective are promotions, especially with pricing pressures? Any news on tariff policies? Huge potential swing factor. And obviously the Q3 results themselves. Need to see how demand holds up and if they're starting to recapture any margin.
And longer view, medium-term.
Success of that product refresh. Is it driving better sales mix, improving conversion, boosting the direct-to-consumer business? Also, the customer journey stuff, does the new loyalty program gain traction?
And the store expansion plan.
Yep, track that too. Does opening 50 stores really pay off? And keep watching capital allocation buybacks, dividends, how they contribute to total return while managing everything else. Macro factors like inflation, trade policy, they'll continue to matter too, of course.
Lots to keep an eye on. Okay, let's switch gears. It's time for our This Is Not Financial Advice segment. Throw out an outrageous but plausible trade idea based on everything we've discussed. Q2 beats, Q3 headwinds, new CEO pivot. What's a wild card play?
All right, not financial advice, remember? But thinking about that market overreaction, the recovery, and the detailed plan management has. Here's a thought. A bull call spread.
Okay, explain that.
You'd buy a call option that's slightly out of the money, meaning the strike price is above the current stock price. Then you'd simultaneously sell another call option with the same expiration date, but further out of the money, so a higher strike price.
Then the expiration.
Set it for shortly after the Q3 earnings release.
Okay, so what's the outrageous bet here?
You're betting the market is still overestimating how bad the tariff impact will be in Q3. And maybe more importantly, underestimating how quickly the new CEO's pricing tweaks and product changes can take hold and resonate.
So betting on a positive surprise, or at least less negative than feared.
Exactly. Hoping for results that push the stock through that current cautious sentiment. The beauty of the spread is your risk is defined and limited. It's the net cost of the options. But your potential reward is capped too by the difference in strike prices.
So defined risk, capped reward. Betting on strategic execution, surprising the market.
Pretty much. Especially if customers accept the price adjustments better than feared. It's a gamble on agility winning out over those perceived headwinds sooner than expected.
It's interesting play. Okay, let's wrap this deep dive up. J.Jill's Q2 FY25. Strong beats on the headline numbers.
Yep, EPS and revenue looked good.
Clear strategic plan from the new CEO. Product customer operations. Seems comprehensive.
Very much so, laying out a clear path.
But significant tariff headwinds casting a shadow, leading to a cautious Q3 outlook.
That's the tension, isn't it? Proactive management versus some tough external pressures. Classic retail challenge. They're leaning on cash generation, that strategic plan.
But the big question remains, can those initiatives really overcome the tariff hit? And will the customers stick with them, especially if prices go up?
That's the core question for the next few quarters. It's a real test of brand loyalty, pricing power, and execution. How quickly can the product refresh gain traction?
Absolutely. It's a fascinating situation to watch unfold, a real test of leadership in a tough market.
Definitely.
And just a reminder to everyone listening, all the information we discussed here is for informational purposes only. It's absolutely not financial advice.
Please, always do your own research. Talk to a financial professional before making any investment decisions.
We hope this deep dive gave you some useful insights into J.Jill's situation and their strategic path forward. Thanks for tuning in to The Deep Dive.